Welcome to the Artisan Podcast, where we share insights from the investment world's leading minds. Today, you're in for a real treat. We have Wang, Alpine Macro's China strategist, directly from China.
Hey, Joe. Good to see you again. Thanks for having me. It's a pleasure to be here.
Nice.
So I have been in China for the past 4 months. So the purpose of the trip is a combination of business and personal, because I've been traveling to China in the past several years, every year, quite frequently actually. But my last trip to China was February 2020. So it was the beginning of the pandemic. So then in the past year and a half, I wasn't able to come back, obviously, but I needed to get a sense of what's really happening on the ground. So as soon as the kind of situation began to ease a little bit, and then I came back. So the trip was actually quite complicated because I was quarantined in hotel rooms for 4 weeks. So so basically I was confined in hotels without doing anything in the first month, basically.
I hope at least the food was decent.
Yeah, the food was okay, but I guess one thing that I kind of I sensed is the purchasing power of the RMB, of the Chinese currency, is quite decent because if we compare the hotel rooms and 3 meals a day taken together and delivered to your door, the price was quite cheap actually, especially a lot cheaper than we have to pay in Canada. So I guess that supports the view that maybe the RMB has more room to appreciate.
Another advantage of China, a cheaper quarantine.
A cheaper quarantine, definitely, yeah.
So, I mean, if we take that, the kind of hard line that China's taking towards COVID and combine this with the Omicron, which is so much more contagious, what do you think of the risk of China, entering a hard landing?
Yeah, so I guess we need to define how we define what is a hard landing, right? So actually here we can bring up some charts. So are you able to see the chart, Joe?
Absolutely.
Okay, great. Yeah, so I think here you can see if you look at the Chinese GDP growth on the left-hand side, Chinese real GDP growth peaked over 18% in Q1, right? So then after that, we see the Chinese economy. If our model predicts GDP will probably drop below 4%. So from 18% to 4%, obviously, it's a massive decline. So a big part of that was the base effect, right? So last year we had a collapse. So base effect obviously is true, played a role here. But I think more importantly, as I'm in China, I'm talking to people, I get a sense of what's happening on the ground. The economy is quite weak. So we did have a major growth slowdown. Whether you call it hard landing or soft landing, the slowdown has happened quite clearly. And on the other hand, we see Chinese stock prices, both in the onshore market and offshore market. Chinese stock prices have dropped like 35% from the peak. So from there, you can also say, the economy, the financial market has had some kind of landing. So I guess the reason for the such a kind of pretty significant slowdown, quite a couple of reasons. Reason number one, you mentioned on the right hand side here. This is basically the way that they are dealing with this COVID crisis has had repeated shocks on the economy. So here, this is just the Chinese new domestic COVID cases since the beginning of the year. So basically, we can see a few mini outbreaks. So because China has had this zero tolerance policy, whenever we had a mini outbreak, then the whole country really tightened restrictions, especially local governments. They tightened restrictions very, very aggressively. So I was in China in the end of July. So during that period, we had a outbreak. So that's why normally I was supposed to be quarantined for 2 weeks, but because of that mini outbreak, then I was quarantined for 4 weeks. So then you can see the COVID policy really tightens whenever they have a outbreak. So then they have kind of repeated shocks on the economy. So obviously we had another outbreak, and if you mention and you also mentioned we have the new variant, then chances are they will tighten again. So they will just introduce repeated shocks to the economy. So nothing wrong with that, right? So obviously they have been in China has been quite successful in containing the virus. But the problem is whenever they had this kind of tightening in restrictions, the private sector contracts, retail sales begin to contract. Traveling basically at least slows a lot. But then public sector is supposed to step in. The public sector is supposed to support aggregate demand. Otherwise, you would have a growth problem. But that's precisely what the Chinese government has not done. So if you look at on this chart on page 3, on the left-hand side, the blue line is infrastructure investment. And the red line is government expenditure. So throughout the whole year, the economy was repeatedly hit by all these mini outbreaks, but the public sector was also actually in a retrenchment. So that's the key reason why the economy has slowed quite a lot. And on the right-hand side here, it's quite clear, right? So if you look at on the right-hand side top panel, this is China's fiscal thrust. Fiscal thrust has been negative since the beginning of the year. And bottom panel, this is total social financing. So total social financing, this is the kind of aggregate financing the Chinese corporate sector, the entire households, or the government sector, they get to the entire economy. We had a material slowdown. So all these are the reasons why we had such a dramatic growth problem. We had the COVID policy without public sector help, and we have a tightening on both fiscal and credit policy. So these are the reasons why the economy has weakened quite significantly. So I think overall, my sense is the economy will remain quite weak, at least in the near term. So a couple of reasons for that. If you look at this chart on page 4 on the left-hand side, so I think now, obviously, we have a new problem, which is the housing market. So the housing market was actually quite strong throughout the pandemic, but then in the past couple of months, the housing sector began to really cool off. I'm sure you've heard of Evergrande problem. So now Evergrande is still a risk in the economy, in the marketplace. But what has clearly happened is because of the headline risks of the real estate sector, home sales have slowed dramatically, and mortgage lending has also slowed dramatically. So these are, real estate is a very big part of the Chinese economy, right? So if you have such a kind of a clear downtrend, then obviously the economy will suffer. So this is kind of looking forward. I think the real estate sector remains a headwind for the Chinese economy. And another headwind for China will be exports. So actually, if you look at the Chinese economy, among all these sectors, exports have actually been doing phenomenally well. Even in most recent month, export growth is still over 20%. So it's still very, very strong. But a big part of the increase is actually due to price increase. In terms of volume actually has been a lot less robust than the overall growth. So that has implications for labor market, right? So if you look at this chart, this is the on the right hand side, the red line is Chinese PMI new export orders. Actually has been below 50 for the past, I think, 3-4 months. And the blue line is small-sized enterprises PMI. So because China, majority of Chinese exports are done by small and medium-sized enterprises. So the fact that export sector, we especially going into next year, Chinese exports benefited this year because other countries have been in lockdown. But if the lockdown in other countries begin to relax, then the supply chains in other countries will begin to normalize. That will also kind of take some market share away from Chinese exports. So that will also mean the export sector will struggle and the small enterprises will struggle. So these are the reasons why I think the economy will remain quite weak. But on the other hand, I think from policymakers' point of view, they are most concerned about the labor market. So why I think this chart is important is because majority of Chinese job creation is done by small and medium enterprises. So we have a really weakening. The outlook of the labor market is weakening. So I think that will really pressure the Chinese policymakers to begin to ease policy more aggressively. So now we are seeing the transition from policy tightening, which has led to a very clear downtrend in the Chinese economy, to a reflation process where hopefully they have enough policy stimulus to support a gradual upturn in the credit cycle and in the business cycle. Yeah. So I think these are kind of some charts that we can actually we see some tentative signs of that. If you look at on page 6 here, so this is the Chinese money supply has kind of stabilized at record low level. So this is below 10, I think around 8%. And Chinese credit impulse. This measures the change in credit flow. So we can see the credit impulse after a massive decline. Now it appears to be stabilizing and begin to improve. So this is these are some of the most important indicators for us to monitor how the Chinese economy will be. Because if you look at on the right hand side, the red line is the credit impulse. It's the same thing as the left hand bottom panel. And the blue line is our indicator for Chinese business cycle. So we can see in the past, especially in the past 10 years, we had a few very pronounced credit cycle fluctuations. And each time, so basically we can see the blue line, the Chinese business cycle fluctuation has been almost entirely driven by the credit cycle with a time lag, obviously. So now if we are seeing the credit cycle is kind of bottoming, chances are the business cycle will continue to decelerate in the next maybe 2-3 months. But then after that, probably business cycle will begin to bottom out. So that's our kind of our theme now. We believe China is in the transition period from policy tightening to policy reflation, and from growth deceleration to a period of bottoming process.
Yeah, I have some questions about the slowdown and the risks there, and then also the policy reflation. So at the start, you were speaking about definition. Well, let's just define it the way that we normally would in North America. Two down quarters. So the third quarter was essentially zero growth, and so if there was a crackdown, in reference to COVID, maybe we could be back into that in the fourth quarter. What do you think are the risks of something close? I mean, because trend growth in China is much faster than in North America. So what's close to 0% growth over a couple quarters? Well, what's the risk there?
Yeah, so I think in Q4, most likely growth would continue to decelerate from Q3. In Q3, I think it's 4.8, something like that. And then Q4 most likely will be fall below 4%, probably maybe slightly above 3%, because the economy, all the leading indicators are still slowing. And if you look at our chart here, it's approaching a bottom, but it's not improving yet. So most likely growth will remain. Basically, the growth news out of China will be weaker before they get better.
Okay. Okay. And maybe let's talk a little bit about what that means, for markets, because there aren't that many economists here. People are really kind of interested in how to make money, or at least how to avoid losing money. So, what do you think this means for commodities, which were strong up until really, a couple of weeks ago? Do you think that the slowdown in China has been discounted in the commodity markets, and then after that we'll speak about the Canadian dollar?
No, I don't think the Chinese slowdown has been discounted in the commodity market. That's why we are cautious. We are bearish on especially on base metals.
Okay.
For fossil fuel, we have different view because we recognize the supply bottlenecks in fossil fuel. So we are more bullish on fossil fuel on especially on crude oil.
Okay.
But on base metals, we see downside. So actually, we can see one more chart here. If you look at this chart on the left-hand side, top panel, this is commodity prices versus Chinese M1. Bottom panel is copper prices versus Chinese copper imports.
Okay.
So obviously, historically, the correlation is very clear. So here, obviously, we see downside, simply because Chinese consumption of base metals account for over 50% of global total, right? So if we have Chinese slowdown, then obviously, the demand for commodities will slow quite a bit. So that's why I think purely from the demand side, I think, and especially for base metals, they do not really have that kind of supply bottlenecks, the same supply bottlenecks as the fossil fuel sector. So that's why we see downside risk for commodities. For the Canadian dollar, we are less bearish on Canadian dollar. We're actually more bullish on Canadian dollar because we are bullish on oil. Number one. Number two is we believe the Canadian economy is reasonably strong, and the Bank of Canada will tighten. At least the policy kind of discrepancy between the Fed and the BOC will not be as big as with other major economies. So actually, we are more bullish on the Canadian dollar, especially the C dollar has weakened by so much in the past couple of sessions.
Okay, and commodities tend to be a little bit more coincident,
right?
Where stocks are more leading. So maybe stocks wouldn't be so focused on the current slowdown in China, and they might be. And in fact, if you look historically, they're much more sensitive to the policy reflation. They're very sensitive to the chart you showed on M2. They're very sensitive on the chart you showed on social financing. So how close are we to this handoff from growth slowdown to policy reflation? EM stocks have underperformed for over a decade and massively this year. When is it going to be time to step in and bottom fish, EM or China?
Yeah, so I think it's probably a bit early to bottom fish EM now for a couple of reasons. Reason number one is, we showed this chart earlier, right? So we see Chinese slowdown has become quite advanced. China is probably in the bottoming process. But China, because China has been such a big marginal driver of the global economy, the impact of the Chinese credit cycle downturn I think, is just beginning to be felt by other major economies. Commodity is only here. If you look at on the right hand side here, this chart, this is exports, global exports. Again, the cycle has been pretty synchronized. China has been leading, and then so basically for EM. We have commodities and we have global trade. EM countries are either sensitive to global trade or sensitive, like in Asia, or sensitive to commodities, which are LATAM countries or South Africa, Russia, right? So all EM countries will be impacted by the slowdown in China, but not just in EM, right? So if you look at here, this is Chinese credit cycle versus Euro area manufacturing PMI, and even the US. Right, so you can see the point I'm trying to make is China is probably already slowdown is already here. It's quite advanced, but other countries are just at the beginning of
Sure.
a downturn, or at least from the China factor. So that's why I think it's probably kind of a bit early to jump into EM. So because we have a growth problem, we have a China growth problem, and we have a global growth problem. Number two is we have a Fed tightening. Fed is tapering, but will probably tighten going into next year. So if the Fed tightens, then basically we have a pretty bearish combination for EM assets because growth is slowing down, and the liquidity conditions are being tightened. So EM typically suffer in this kind of environment. And even in EM, many EM countries are tightening. So I think this chart is quite important. So if you look at EM on the top panel here, the blue line is a EM trading PE ratio versus our policy rate diffusion index. So this index measures how many EM countries are easing versus the number of EM countries that are tightening. So if we have the red line is coming down, it means the majority of EM countries are tightening. So basically, that's a synchronized tightening cycle. So obviously, we see whenever the blue line, the blue line basically follows the red line. So when we have a monetary easing, then we have multiple expansion. Then we have a tightening. Then we have a multiple compression. So now we are in this multiple compression period. And bottom panel is earnings. So if you look at here, bottom panel is trading EPS in EM versus LEI diffusion index. So this leading economic indicator, LEI leading economic indicator, diffusion index, it measures how many EM countries' growth is accelerating versus the number of countries' growth is decelerating. So if we have a moderating, the red line is rolling over, so means that the majority of EM countries' growth rate begins to slow down. I think obviously follows the Chinese downturn. So then here we have a multiple compression combined with weakening earnings. So that's why this is still kind of premature to buy EM aggressively. But I think the point that you made is a very good one because you mentioned precisely this chart is showing here. EM has underperformed DM drastically, right? So from 2010 and so basically we have a 10-year bear market, completely reversed the previous 10-year relative bull market. So here, if we have kind of a long-term trend line, now is 1 sigma below the long-term trend. So we recognize this is an overshoot or undershoot, and EM stocks are quite cheap. Sentiment is very weak. So in here we recognize this is overshoot to the downside. So we may be prepared to turn for so basically the catalysts could include we talked about whether Chinese growth begins to improve after policy reflation. If the inflation begins to kind of peak out in the U.S., then the Fed will begin to at least the hawkishness will peak out next year. Then that will kind of bring some relief on EM countries to tighten, and then the dollar will probably weaken. So on that, we will probably begin to nimble into EM assets.
Sure. I believe actually historically EM relative performance is positively correlated with the Fed because, as you said, EM is driven by growth, and the Fed is usually raising rates reflecting strong growth. I guess a question would be, there's some very important political events next year, the 5-year cycle. And you would think that in China, the government wouldn't want to see the economy as weak as it is now going into those, the major Congress and what have you. Do you think that there'll be no particular stimulus in the lead up to those events, a strong stimulus or a mild stimulus? And given that view, would it be strong enough to basically step in and buy emerging market stocks, or still better? I understand it's a little early now, but is it early or just hands off?
At this moment, we see rising signs that the Chinese policymakers are getting really nervous about the
Okay.
housing market, about the overall kind of sluggishness in the economy, and then especially the labor market. In my view, the labor market next year will be quite challenging. So I
Okay.
think now we see Chinese policymakers are responding to those kind of
Okay.
growing pressure points. So they already cut reserve requirement ratio once, and
Okay.
I think yesterday or during the weekend, the Chinese premier, he said China would cut the reserve requirement ratio again
Okay.
soon. So I think most likely in the next week or so, we would have another kind of major policy announcement. So I do think we are in this process of getting more aggressive policy easing, and especially your point, next year will be a very politically sensitive year in China. They have this major party congress, so most likely they will have to make sure the economy is stable, the labor market is stable, so that they can be a kind of celebrate this party congress. So that's basically will be Xi Jinping's third term. So I think that from that point of view, I think we are early to
Okay.
get into EM.
Uh-huh.
But actually, the only market that we like, or some among the major markets, I think China is actually getting interesting.
Okay.
Because if you look at this chart, on the left hand side, so this is MSCI China
Yeah.
versus EM outside of China. So
Okay.
obviously China has been massively derated.
Okay.
Because of a lot of problems, a lot of regulatory changes, growth
Right.
downturn, a lot of kind of political tension with the U.S. So whatever reason, the
Okay.
slowdown has been quite dramatic. And if we look at on the right hand side bottom panel, this is the three-year rolling drawdown
Okay.
from peak to trough, right?
Okay.
So basically, whenever the market drops by this much,
Okay.
odds of further downside have been significantly reduced from purely from historical point of view. So that's why basically my view is that this market has come down so much,
Right.
and growth downturn has become quite advanced,
Okay.
and the Chinese policymakers are the only major economy that are easing,
Okay.
right? So
Right.
I think those are the reasons why we think it actually it makes sense to be a little bit more aggressive on Chinese assets
Okay.
within
Well,
EM.
given that you have the boots on the ground in China and how cheap the market is and how oversold it is, we would expect that one of your first calls as they reflate is to your friends at Northland, as to when to buy EM or China stocks. So, I mean, maybe this is enough on the kind of cyclical, the shorter term. Maybe we can talk a little bit more about some of these really interesting long-term structural trends that we've seen in China. I mean, first of all, we've seen a pretty big regulatory crackdown, first on tech, internet, and education, most recently on property companies. And then we also are hearing about this big theme of common prosperity versus what has really been kind of growth at any cost over the last couple decades. So maybe you can talk about some of these structural themes, the 5 and 10-year view, and what that means. A decade ago we were buying commodities here in Canada because of what China was doing, but China is still massive. So what are the big themes over the next 5 or 10 years? Either from a regulatory clampdown point of view or a common prosperity perspective.
Yeah, those are really great questions and really tough to answer. So obviously, we don't really have access to what really Xi Jinping thinks, right? So we just try to make sense of what's happening. So I think on the economic front, it's quite easy to see Chinese growth will continue to moderate because precisely because of kind of the policy shift that you mentioned. So basically, all the kind of growth at all costs mentality is gone. So that much is quite clear. And another point is the economy has become quite a lot more advanced than before, right? So if as your base is rising, so all economies face diminishing rate of return, right? So as your base is rising, then the rate of increase will begin to moderate. This is the same as what happened in Japan, in Korea, in Taiwan, in Singapore, in Israel, in many of the kind of newly industrialized economies have gone through. So I don't think that much that will change much. But but also as the size of the economy grows bigger, the impact on the rest of the world may not be smaller than before. So I think that's the key point. In terms of the regulatory changes, I think I prepared some charts because we talked about this before. I just want to show how much China itself has changed. So that's why I think this chart is actually quite important for us to understand that. So this is 100% of the world population, and the gray areas are the Chinese population. China has been around 20% of the world population throughout the past 50 some years. And the blue bars are the countries with population, the population of countries with per capita GDP lower than China. So these are poorer countries, and these are richer countries. So obviously, when China began to reform in 1978, that's the year China began to open up, began to reform. China was the poorest country. Maybe only 2 to 3% of the world population was poorer than the Chinese. So China was absolutely the poorest country. But then throughout, obviously now, even though the Chinese per capita GDP is only like 11,000 or 12,000 US dollar, it's much lower than the US, Europe, Canada, Australia, Japan, Korea, right? So a lot poorer than many developed countries. But all the countries richer than China combined, they only account for less than 20% of the world population. So majority of the world population now are actually poorer than the Chinese. So this is a drastic change and happened in a very short period of time. So I think this is very important starting point for us to understand why policies are changing, because growth at all costs is no longer that important. So that's why we have I published the chart before. I published a report a few years ago. It's called Xi Jinping's shock therapy. So I try to make sense of what happened after Xi Jinping took over. So I think in 2015 there was a survey, public opinion survey, asking what were the top public concerns in 2015. So they listed 15 top concerns. Only 3 of them are related to the economy. Like they are rising prices, traffic. I think traffic probably not even traffic. Maybe I can say an infrastructure problem, right? So then unemployment. So only 3 of these are remotely related to economic issues. Everything else are, like, for example, the top one is corrupt officials. That's what the anti-corruption campaign was all about. The second one, air pollution, water pollution. That's the environmental campaign. That explains why China appears to be determined to reach peak carbon emission in 2035, and then 2060 they want to become carbon neutral. So basically, these are all, and then safety of goods, quality of manufactured goods. So basically, that's related to their campaign to improve people's livelihood. And then the last one, the third one, this is the gap between the rich and poor. That's what this common prosperity is all about. So I think this really explain, all these points explain what's happening, why Xi Jinping is doing that. So these acts are not random. They are actually highly targeted to address some deeply rooted public concerns in the Chinese society. So I think with that, what kind of impact this will have on growth? Probably
Okay.
will be bearish because basically all policies are a trade-off between equality and efficiency.
Okay.
Before
Mhm.
everything was about efficiency.
Okay.
Now the needle is shifting to the other side to equality.
Okay.
So I think growth will probably suffer, but probably at the benefit will be a less volatile, a more stable political and social environment. I think that so basically, I think this addresses the issue. A lot of people are making the case that all these policy changes are random.
Okay.
Somehow China just became turning a communist country. I think it's far from that.
Mm.
So from that point of view, I do not buy the view that China somehow because of that becomes uninvestable. I think
Okay.
that's the bottom line of this.
But I mean, from an absolute perspective, as a capitalist investor, you're interested in profits. So that is more attuned to growth, and it's more attuned to policies that are business friendly. And so if your policies are more in favor of equality, that's not necessarily in the interest of the investor, of the owner of capital. Usually, historically, it's been against their interests. So that would be the absolute argument. I mean, to me, if you're favoring equality over liberty or over growth, it's less friendly to stock market. But then you have a relative question as well. And, to be honest, I'm not sure that that policy is less than it is in countries like Europe and the United States, where
Absolutely.
if you look at the carbon view in the United States, so it may be something that is absolutely necessary. However, it really can impede capitalism, and the government, both fiscally as well as the central bank monetarily, is really having a
Mm.
very strong impact,
Mm.
on the economy. So I guess from an absolute point of view, I mean, would you argue that this can't be negative
Well,
for
first, no,
profitability
no,
and investment?
this is obviously negative.
Okay.
But so this is negative from the point of view that we have the trade-off shifting from pure pursuit of efficiency to
Right.
also to at least the caring for equality. But
Sure.
what I'm arguing against is the view that somehow China just becomes a communist country, which is far from true. Because now I'm in China, right? So now you have business running 24 hours everywhere. Like in
Right.
Canada, we are used to businesses close at 9 p.m. or even 5 p.m. during weekdays.
Right.
In China, like even in China now they have the so-called 996 culture.
Right.
So basically, what they say is employees are expected to work from 9 a.m. to 9 p.m. 6 days a day, 6 weeks, 6 days a week. So this is their 996 work culture. So basically, the I think I remember Jack Ma said, this 996 is it's fortunate for young people to work 996 because if you work harder, then you achieve more, which obviously is true. But can we imagine any business leader outside of China can say that thing, right? So this is to me, I think China is still one of the most capitalist systems countries in the world. It's just
Okay.
it's shifting because of the changes that that we saw here. When the country was really dirt poor, then
Right.
obviously they could do anything. They wanted to do anything to
Right.
become richer. But now, actually, Chinese are among the richer people in the world. Like, that's why
Okay.
we see so many Chinese tourists in other countries, Chinese students in other universities, because they
Okay.
are actually much richer than a majority of the world population. I think that's the
Mm.
key message. But on the other hand, we have cycles, right?
Right.
So if the Chinese, if you look at here, this is Chinese stocks relative to EM. We had a massive underperformance
Right.
uh, so far this year.
Okay.
So even without considering all these kind of long-term problems, then we have cycles here, so the cycle will be in favor for Chinese stocks, based on the cyclical factors that we just talked about.
Okay. So, I mean, I think it comes back to the cyclical that, we're waiting for this reflation, maybe we're past the worst, and, basically to stay tuned to when Alpine macro becomes more positive.
Right. Yeah.
Yeah. Well, I certainly all have my phone open. I think we'd be remiss if we didn't mention some of the saber rattling between China and the U.S. over Taiwan. I know some of your respective counterparts are saying there will be a conflict. What's your view, and what do you think is the view of the people in China? I mean, you've been there for quite some time. When you're speaking to your friends and colleagues, what's the view inside China, and what's your professional view?
Yeah, so I think the risk has obviously increased quite significantly over the past couple of years, especially in the past 2 years.
Okay.
I think the reason for that is China set Taiwan issue. China sees Taiwan issue as completely red line. So there's zero room for compromise if, let's say, Taiwan declares independence, something like that. So there's absolutely zero room for compromise. So if that happens, no Chinese leader can survive a formal independence of Taiwan. So from that point of view, I think something will have to happen. So we just bet, we just hope things will not go that far. But obviously things are moving toward that direction. From both the U.S. side, from the Taiwan side, the current administration, they have a pro-independence agenda from the party, and the U.S. obviously wants to play the Taiwan card in the geopolitical rivalry with China, and I think China is also under this kind of rising nationalism sentiment. Since I'm here, clearly you can sense that. It's not just the Chinese government wants to do it; it's actually the Chinese public, the 1.4 billion population. They want to unify Taiwan. So in their words, so their long-term policy has been peaceful unification with Taiwan. So the emphasis of the rest of the world in the past was the peaceful part, but the Chinese emphasis has been the unification part. Right. So I think that's the key. That's the key problem. Everybody agrees that you would need to peacefully solve this problem, but the Chinese solution is to eventually unify with Taiwan. Right? So I think that's how the two parts see this differently. So how do I see this in the near term? I have a very hard time to believe there will be a real military conflict between China and Taiwan. I think the stakes are too high, the risks are too high, especially Taiwan is only kind of 100 miles off the Chinese coast, and we know Chinese East Coast region is the most prosperous region in China. Majority of population live on the East Coast. Majority of the economy is in the East Coast. So I do not think China wants to risk a real conflict, a military conflict with the U.S. or with Taiwan. Now we have Australia, we have Japan. So long term I'm worried, but in the near term I see risk of a real military conflict is still very, very low.
Okay. Well, that's good enough for me. So let's end on that note. Thank you so much. That was wonderful.
Pleasure talking to you, Joe. Good to see you again.
Absolutely.